Imagine waking up on a Tuesday morning in Brisbane, making yourself a coffee, and knowing that while you slept, your money sent you another paycheck. That is the dream a lot of Aussies are chasing right now. And today, we're going to show you exactly how much you need invested to actually live off dividends forever. Not maybe, forever. Living off dividends in Australia is genuinely one of the most achievable forms of financial freedom on the planet. The reason is something almost unique to us. It's called franking credits. When an Australian company pays you a dividend, they've usually already paid 30% company tax on those profits. Then the government gives you that tax back as a credit. So when you see a 4% dividend yield on the ASX 200, the real grossed-up yield is closer to 5.5%, sometimes even 6%. This system was introduced back in 1987 by the Hawke government to stop the same dollar of profit being taxed twice, once at the company level and again in the hands of the shareholder. Australia and New Zealand are among the only countries in the world that still run a full dividend imputation system like this. In the United States, the United Kingdom, and most of Europe, dividend investors get hit with double taxation. That's why an ASX portfolio paying 4% can outperform a US portfolio paying the same headline yield on an after-tax basis. Pretty amazing, right? Let's start with the number that matters most. How much do you actually need to live a comfortable life in Australia? The Association of Superannuation Funds of Australia, which is the gold standard for this kind of research, says a single person needs around $54,000 a year for a comfortable retirement. A couple needs around $77,000. That's having private health insurance, running a car, taking a domestic holiday, and going out for dinner without stressing. Of course, if you want the lean version, a modest lifestyle is closer to $35,000 for a single and $51,000 for a couple. And if you're chasing the full-fat lifestyle, overseas trips, eating out whenever you want, maybe upgrading the car every few years, you're realistically looking at $100,000 or more per year. Now here's where it gets really interesting. The average dividend yield across the ASX 200 sits at around 4% in 2026. Once you add franking credits, that grosses up to roughly 5.5%. If you go heavier into high-yield names, you're looking at a yield closer to 5.5% to 6% before franking and around 7% grossed up. So, depending on how you build your portfolio, your real yield is somewhere between 5% and 7% in today's market. Let's use 5.5% as a sensible, realistic number for someone holding a diversified Aussie dividend portfolio. Let's run the actual math. If you want $50,000 a year in income, you divide that by 5.5%, and you need around $910,000 invested. If you want $75,000 a year, you need roughly $1.36 million. If you want $100,000 a year, you need about $1.82 million. And if you want to live the genuinely luxurious life on $150,000 a year, you're looking at around $2.7 million. Here's the part that should excite you. These numbers aren't reserved for high-income earners or people who inherited money. The average Aussie who starts early enough and stays consistent will absolutely hit these targets. But hold on, there's a catch most people forget: tax. Even with franking credits, you still pay marginal tax on dividend income above certain thresholds. The good news for Aussies is the tax-free threshold is $18,200, and franking credits effectively shield a huge chunk of your dividend income from extra tax. In fact, if dividends are your only income, you can earn around $30,000 in fully franked dividends and pay basically zero net tax because the franking credits offset your tax bill completely. Let's look at a concrete example. Say you receive $25,000 in fully franked dividends. That comes with about $10,700 in franking credits attached. Your taxable income becomes $35,700, but the tax payable on that amount is roughly $3,500. The $10,700 credit wipes out that tax entirely, and the government actually refunds you the difference. That's right, you can get a tax refund without earning a single dollar of salary. Now let me show you the path most people miss. You don't need to save $900,000 from scratch. You need to invest consistently and let compounding do the heavy lifting. If you invest $1,500 a month into a diversified Aussie share portfolio, averaging 8% total return, which is well below the long-term ASX average of around 9.5%, you'll hit $900,000 in about 19 years. Bump that to $2,000 a month, and you're there in around 17 years. Start in your late 20s, and you're financially free before 50. That's not a fantasy. That's just the mathematics of compound returns meeting consistent habits. The other lever most people ignore is the account structure used to hold these investments. Holding dividend-paying shares inside superannuation means the income is taxed at just 15% during accumulation and 0% in pension phase once you reach preservation age. That's why a lot of Australians targeting dividend freedom run a dual-track strategy. One portfolio inside super for long-term tax efficiency, and a second portfolio outside super for income that can be accessed before preservation age. For example, someone aged 40 might put $800 a month into super, invested in high-dividend ETFs, and another $700 a month into a separate brokerage account. By 60, the super balance could be generating $60,000 a year tax-free, while the outside account might generate $40,000 a year. That's a combined $100,000 of annual dividend income, with almost no tax paid. But here's the thing. Chasing the highest yield is the single biggest mistake new dividend investors make. If you see a stock paying 12% on the ASX, it's almost always a value trap. Either the price has collapsed because the business is in trouble, or the dividend is about to be cut. The companies that pay sustainable, growing dividends decade after decade are the boring ones. The big banks, Commonwealth, NAB, Westpac, ANZ, Wesfarmers, BHP, Telstra, Woolworths, the major insurers like QBE and Suncorp. They're not exciting, but they pay you forever, and forever is the goal here. Think about Commonwealth Bank. It has paid a dividend every single year since going public in 1991, over 30 years of consistent payouts. During the GFC, during COVID, through every crash, the dividend kept flowing. That's the kind of reliability that lets you sleep soundly while your portfolio works. There's also a smarter way to do this than picking individual stocks, especially when you're starting out. Aussie dividend ETFs do the heavy lifting for you. VAS gives you the entire ASX 300 with a yield around 3.5% to 4% plus franking. VHY targets higher-yielding companies with around 5% to 6% before franking. There's also iShares IOZ, BetaShares INCOM for monthly income, and a few others that give you instant diversification across 50 to 300 dividend-paying companies with one single trade. For most Australians, a simple 2 ETF portfolio will outperform 90% of stock pickers over 20 years, and you'll sleep a lot better. It's also worth knowing how these distributions actually land in your account. Most Aussie ETFs pay quarterly in January, April, July, and October. Individual ASX shares typically pay twice a year, interim dividends around February or March, and final dividends around August or September. See you in the next video.